You open your banking app, you see that number. Your savings account balance, maybe it's a 5,000, maybe it's a 50,000, and you feel good about it, responsible, safe, smart. You're doing exactly what your parents told you to do. What every financial advisor on morning television says you should do. You're saving for a rainy day. But here's what nobody's telling you. While you've been stashing away your hard-earned cash, thinking you're building wealth, someone else has been getting rich off your money. And it's not you. Right now, at this very moment, your savings account is quietly destroying your financial future. And the worst part, you probably have no idea it's happening. Let me show you something. In 1980, the average savings account in America paid 5.25% interest. Put on 10,000 in the bank, and you'd earn 525 that year just for letting it sit there. Not bad, right? Fast forward to today, that same 10,000 earns you about 46 a year. Some banks pay even less. We're talking 0.46% interest on average, 0.46%. But here's where it gets interesting. And by interesting, I mean absolutely insane. While your savings account pays you 0.46%, the bank takes that same money and lends it out at 7%, 10%, sometimes 20% interest on credit cards. They're making massive profits on your money. Money you think is safely sitting in your account. You're not a customer. You're the product. The origins of this system go back further than you think. After World War II, America entered the golden age of banking. The economy was booming. Jobs were plentiful. And banks actually competed for your deposits. They had to. Because your money was valuable to them, and they knew it. Back then, savings accounts were legitimate wealth-building tools. Your grandfather could put money in the bank and watch it grow at rates that actually beat inflation. A dollar saved was truly a dollar earned, sometimes more. The Federal Reserve kept interest rates high enough that saving made sense. Banks paid 4%, 5%, even 6% on basic savings accounts. Park a 10,000 for a decade and you'd have real growth, actual purchasing power. But something changed in the 1990s and early 2000s. The rules shifted, banking deregulation happened, technology exploded. And banks realized something crucial. They didn't need to pay you anymore. See, before the internet, banks needed physical deposits. They needed your cash in their vaults to make loans. It was a simple equation. More deposits meant more loans. More loans meant more profit. But then came electronic banking, digital transfers. The Federal Reserve's expanded lending facilities. Suddenly, banks had access to cheap money from dozens of sources. They could borrow from the Fed at near zero rates. They could tap into wholesale funding markets. They could issue bonds. Your checking account deposit, your savings account balance, they became optional, nice to have, but not necessary, and that's when the game changed forever. The financial crisis of 2008 sealed the deal. The Federal Reserve dropped interest rates to basically zero, and they stayed there for years. The justification was economic stimulus. Keep rates low, encourage borrowing, jumpstart the economy. But here's what really happened. Banks got addicted to free money. They could borrow from the Fed at 0.25% and lend to you at 4% on a mortgage, 7% on a car loan, 18% on a credit card. The spread was enormous. Their profits soared. And your savings account, it paid nothing. Because they didn't need it anymore. You became a relic, a legacy system they had to maintain for regulatory purposes. The government requires banks to have deposit insurance, to maintain certain ratios, to keep a baseline of customer accounts, so they keep your savings account open. They even smile when you make a deposit, but they're not paying you what your money is worth. Not even close. Let's talk about inflation, because this is where the true crime happens. From 2020 to 2023, inflation in America averaged around 5% per year. Some years it hit 8%. Your grocery bill exploded, gas prices doubled, and your savings account, still paying 0.46%. Do the math. If inflation is 5% and your savings account pays 0.46%, you're losing 54% of your purchasing power every single year. That 10,000 in your account. After 1 year of 5% inflation, it now buys what 9,500 would have bought 12 months ago. You didn't spend a dime, but you lost 500 in real value. This isn't saving. This is slow-motion financial suicide, but it gets worse. Because banks aren't just paying you nothing. They're actively charging you to lose money. Monthly imbalance fees, ATM fees, overdraft fees, wire transfer fees. The average American pays $329 per year in banking fees. On money that's already losing value to inflation. You're paying them to make you poorer. And the banks, they're having their most profitable decade in history, Morgan Chase posted 48.3 billion in profit in 2023. Bank of America made 27.4 billion. Wells Fargo pulled in 19.1 billion, record profits, while paying you 0.46% interest. The system isn't broken. It's working exactly as designed, just not for you. Now here's what makes this truly sinister. The reason you keep your money in savings accounts, the reason we all do, it's fear. Fear of the stock market. Fear of risk. Fear of losing everything. We've been conditioned to believe that cash in the bank equals safety, that anything else is gambling. And banks know this. They exploit it. They market themselves as the safe choice, the responsible choice. But safety is an illusion when your money loses value every single day. The truth is, savings accounts made sense in 1980. They made sense in 1990. They even made sense in 2005. But today, in 2024, they're financial quicksand. And yet Americans have over $6 trillion sitting in savings accounts right now. $6 trillion earning almost nothing. Losing value to inflation, making banks rich. $6 trillion of collective financial ignorance. But to understand just how devastating this really is, we need to look at the mathematics. The real numbers that banks pray you never calculate. Let's run a simple experiment. Two friends. Both have 10,000. Both want to grow their wealth over 10 years. Friend 1 does the responsible thing. She puts her money in a high-yield savings account. Not the terrible 0.46% account. A good one that pays 4%. She's proud of herself. She's earning interest. Friend 2 takes a different path. He puts his 10,000 into a basic S&P 500 index fund. Just buying a piece of the entire American economy. Nothing fancy. Nothing risky by investment standards. 10 years later they check their accounts. Friend 1 has 14,802. She made 4,802 in interest. Not bad, right? She never lost a penny. She slept well every night. That's worth under 25,937. He made 15,937. More than triple what she earned. But wait, it's actually worse than that, because we forgot about inflation. Over those 10 years, inflation averaged 3% annually. So friend 1's 14,080 actually has the purchasing power of about 11,005 in today's dollars. She made 1,005 in real terms over a decade. Friend 2's 25,937 has the purchasing power of 19,288. He made 9,228 in real wealth. Friend 1 earned 7,005 over 10 years. Friend 2 earned 9,288. Same starting amount, same time period, 9 times more wealth. But here's the part that should terrify you. Let's extend this to 30 years. Because that's how long most people save for retirement. After 30 years, friend 1 has 32,434. Sounds pretty good. She more than tripled her money. Friend 2 has 174,494. He increased his wealth by 17 times the difference, a 142,060. That's not a rounding error. That's a different life. That's retiring at 62 instead of 75. That's financial security instead of financial anxiety. And remember, this is with a 4% savings account. Most savings accounts pay less than 1%. Run those numbers and the gap becomes even more catastrophic. This is the invisible tax on financial ignorance. And banks count on you never doing this math. But let's go deeper. Because the scam is layers. Banks take your savings deposits, and they don't just sit on them. They use something called fractional reserve banking. For every dollar you deposit, they're legally allowed to lend out approximately 0.90. The bank now lends out 9,000 to someone else. That person deposits it in their account. The bank lends out 80 to 100 of that, then 7 to 90, then 60, 61, 110,000 deposit creates nearly 50,000 in loans through this multiplication effect. And the bank collects interest on all of it. Your 10,000 becomes the 50,000 in loan revenue for them. They pay you 0. They charge borrowers 7% on 50,000. Do that math. That's 2,300 in interest income for them, minus 4,600 paid to you. Net profit 2,254 on your 10,000 deposit. And this happens every year, compounding, multiplying, generating billions in profit. You get 46, they get 254 from your money. This is why bank executives make 8-figure salaries. This is why bank stocks consistently outperform the market. This is why banking lobbies are the most powerful in Washington. They've built an empire on paying you nothing. Now here's where it gets personal. Let's talk about your actual situation, right now. Today, if you're 30 years old with 20,000 in savings, you think you're being smart. You have an emergency fund. You're prepared. You're responsible. But here's the reality. At 0.46% interest with 3% inflation, you're losing 509 per year in purchasing power. Over the next 30 years until retirement, that 20,000 will have the buying power of 8,240 in today's dollars. You'll have lost more than half your wealth by doing nothing, by being responsible. Meanwhile, if you'd invested that 20 other $1,000 in a diversified portfolio averaging 10% returns, 1,000 at age 60, in today's dollars accounting for inflation, that's about 144,000. The difference between 8,240 and 144,000 is 135,760. That's not theoretical. That's real money you won't have. Real vacations you won't take. Real security you won't feel. Real choices you won't get to make. All because you kept money in a savings account. But banks have convinced you this is fine, normal, safe. They've run a decades-long marketing campaign to keep you scared of investing, to keep you dependent on their system. Every bank commercial shows happy families, secure retirements, smiling elderly couples on beaches, and they all have one thing in common. They saved with us, they were smart, they were safe. What they don't show is the reality. The family that saved 100,000 over 30 years and watched inflation turn it into 45,000 in purchasing power. The retiree who safely kept everything in savings and now can't afford medication. That's not in the commercials. Here's another layer of the scam. High-yield savings accounts. Earn up to 4-5% APY. Sounds amazing compared to 0.46%, right? But read the fine print. That 4-5% is introductory, for 3 months. Then it drops to 2%, then 1%, then 0.5%. And by the time you notice, you've been locked into their ecosystem. Plus, those high-yield accounts have restrictions. Maximum balance limits, monthly transaction limits, complex qualification requirements. You have to jump through hoops to earn their generous interest. Meanwhile, the stock market is open to anyone. No maximums, no transaction limits, no qualification requirements, just better returns. But banks won't tell you that. Let's talk about certificates of deposit. CDs. Banks love these too. Lock in your money for 1 year at 5% interest. Seems like a good deal, but think about what you're actually doing. You're giving the bank guaranteed access to your money for a fixed period. They know exactly how long they can use it. They can plan their loans accordingly. They can maximize their profit. And you're locked in. Market crashes. Can't access your money without penalties. Emergency expenses, pay a fee. Better investment opportunity, too bad. You're stuck, they get certainty. You get trapped. And they pay you 5% for the privilege of controlling your capital. That same money in investment stays liquid. You can access it anytime, no penalties, no restrictions, just better returns and more freedom. But CDs sound safe, they sound smart, so people buy them. And banks laugh all the way to their quarterly earnings report. The real genius of the banking system is how they've normalized this. How they've made losing money feel like winning. You see, it went from 10,000 to 10,046. You feel good, you made 46. That's 46 you didn't have before, but you didn't make 46. You lost to 254 if inflation was 3%. You just don't see it. The number went up, so your brain registers a win. Banks understand psychology. They understand that humans respond to nominal gains, not real returns. As long as the number gets bigger, you feel successful. Even if your wealth is shrinking, it's financial sleight of hand, and it works on millions of people every single day. Here's what banks don't want you to know. They need your deposits less than ever, but they still market savings accounts aggressively. Why? Because deposits are cheap. Cheaper than any other funding source. They pay you 0.46%. They borrow from other banks at 5%. They issue bonds at 6%. Your savings account is their cheapest source of capital, so they spend millions on advertising to keep you depositing, to keep you believing savings accounts are smart, to keep you scared of alternatives. It's not about helping you. It's about maximizing their profit margins, and the regulatory system enables this. The FDIC insures deposits up to $250,000. Sounds great, sounds like protection, but what it really does is eliminate competition. It removes the incentive for banks to pay you more. Why would they? Your money is already insured. You already feel safe. They don't need to offer better rates to attract deposits. The insurance that protects you also protects their profit margins. But the biggest scam of all, the emergency fund myth. Every financial expert tells you the same thing. Keep 3 to 6 months of expenses in savings. For emergencies, this is gospel. This is universal advice, and on the surface it makes sense. Emergencies happen, job losses, medical bills, car repairs. You need liquid cash. But here's what they don't tell you. That emergency fund is costing you a fortune in opportunity cost. And there are better ways to prepare for emergencies that don't require financial suicide. But to understand the real damage, the true cost of this system, we need to look at what happens next. At the aftermath of a generation that saved instead of invested, the year is 2024. Baby boomers are retiring in record numbers, 10,000 per day, and they're discovering something terrifying. They don't have enough money. These are people who did everything right. They worked 40 years. They saved diligently. They put money in the bank every month. They were responsible. They were careful. They followed the rules. And now they're broke. The average retirement savings for Americans aged 65 and older is $200,000. Sounds like a lot, right? Until you realize that needs to last 20 to 30 years. That's $600-700 per year. Less than $600 per month. Try living on that. Try paying for housing, food, utilities, medication and entertainment on $600 per month. It's impossible. Social Security helps. The average benefit is $9 to $7 per month. Add that to your $600 from savings and you get $2, $5 and $7 monthly. About $1,000 per year. That's poverty. That's choosing between medication and groceries. That's being one emergency away from financial catastrophe. This is what safety looks like. This is what savings accounts built. But here's the tragedy. It didn't have to be this way. If those same retirees had invested even half their savings, they'd have 3 to 5 times more money. They'd be comfortable, secure, free. Instead, they're terrified. And banks are still making billions. The system created a generation of financially crippled retirees. And it's about to get worse. Because millennials and Gen Z are making the same mistakes. Right now, 42% of millennials keep most of their wealth in savings accounts. They watched their parents lose everything in 2008. They saw the dot-com bubble burst. They learned that investing is dangerous. So they're saving. And they're losing. Just like their parents. The cycle continues. The banks keep winning. And Americans keep getting poorer while thinking they're being smart. But let's talk about the alternative. Because this isn't just about criticism. It's about solution. What should you do instead of savings accounts? Where should your money actually go? First, keep 1 month of expenses in checking. Not savings. Checking, that's your buffer. Your immediate access fund. Everything else needs to work harder. Second, max out your 401k match. If your employer matches 6%, you contribute 6%. That's free money. That's an instant 100% return. No savings account on earth can compete with that. Third, open a Roth IRA, max it out every year. $7,000 for 2024. That money grows tax-free forever. Every dollar you put in at age 4 times be 21 by age 65 if markets average 10%. Tax-free. Fourth, the rest goes into index funds, total market funds, S&P 500, international stocks, real estate investment trusts, diversified, simple, effective. That's it. That's the system. No savings accounts. No CDs, no high-yield traps. Just investing in assets that actually grow. But what about emergencies? This is where people panic. What if I need cash fast? Here's the secret. Brokerage accounts are liquid. You can sell stocks and have cash in 2 business days. For true emergencies, you can use a credit card and pay it off when the cash arrives. 0 interest if you pay within the grace period. You don't need 20,000 rotting in a savings account just in case your car breaks down. You need 20,000 growing in investments with a 5,000 credit limit as backup. Same security, massively better returns. But you say, what if the market crashes? What if I invest and lose everything? Valid question. Let's address it. The market does crash. 2008 happened. 2020 happened. 2022 happened. Crashes are real. But here's what history shows. The S&P 500 has never had a negative return over any 15-year period. Never. Not once in 100 years. If you invest for the long term, you win. Always. Yes, you might lose 30% in 1 year, but you'll gain 40% the next. Over decades, it averages to 10% annually. That's not speculation. That's historical fact. Your savings account has a 100% chance of losing to inflation. The stock market has a 0% chance of losing over 15 years. Which is actually safer? Banks have convinced you that volatility equals risk. But real risk is running out of money in retirement. Real risk is working until you're 75 because you saved instead of invested. Volatility is just numbers moving on a screen. Risk is dying broke. Now let's talk about the future. Because this system can't last forever. Something has to break. Interest rates are rising. The Federal Reserve is fighting inflation. And banks are starting to pay slightly more on savings accounts. Some are up to 4% or 5% now. Is that enough? Should you start saving again? No. Because 5% barely beats inflation. You're treading water at best. And the moment inflation drops, banks will slash those rates back to nothing. You'll be stuck again. The temporary spike in savings rates isn't a return to sanity. It's a brief anomaly. A blip. Within 2 years we'll be back to sub 1% accounts. Because banks don't need your deposits. They'll never pay you what your money is really worth. The game is rigged. It's always been rigged. It will always be rigged. Your only move is to stop playing. But here's what gives me hope. Information is spreading. Young people are learning. TikTok and YouTube have created a generation of financially literate teenagers who understand index funds better than their parents. The old system is dying. Slowly. Painfully. But it's dying. Apps like Robinhood, Fidelity, and Vanguard have made investing accessible. Free trades, no minimums, simple interfaces. The barriers are gone. You can open a brokerage account in 5 minutes from your phone. You can buy index funds with 100. You can automate monthly investments. It's easier than setting up a savings account. The tools exist. The knowledge exists. The only thing missing is the courage to act. Because that's what this really comes down to. Courage. The courage to reject what you've been taught. The courage to trust data over fear. The courage to take control of your financial future. Savings accounts feel safe because they're familiar. Because everyone uses them. Because your parents told you to. Because banks have massive marketing budgets. But safe and familiar aren't the same thing as smart. Slavery felt normal for thousands of years. Smoking was doctor recommended in the 1950s. Leaded gasoline was considered safe. Asbestos was a miracle material. Normal doesn't mean correct. It just means common. And right now, millions of Americans are making a common mistake. They're watching their wealth evaporate in savings accounts. They're sacrificing their futures for the illusion of safety. You don't have to be one of them. Here's my challenge to you. Open your banking app right now. Look at your savings account balance. Calculate how much you're losing to inflation every year. Then imagine that number multiplied by 10, by 20, by 30. Imagine what your life would look like with that much more wealth. That's not fantasy. That's math. That's what happens when you invest instead of save. Now ask yourself one question. Are you willing to stay comfortable and end up broke? Or are you willing to feel uncomfortable now and retire wealthy? Because that's the choice. There's no middle ground. There's no safe path that also builds wealth. The old rules don't work anymore. You can follow your parents' advice and struggle. Or you can follow the data and thrive. The banks are counting on you to choose comfort. They're betting that fear will keep you frozen. They're wagering billions that you'll never do the math. Prove them wrong. Move your money. Open that brokerage account. Buy those index funds. Start building real wealth. Not tomorrow, not next month. Today, because every day you wait is another day of losses. Another day of opportunity cost. Another day the banks get richer while you get poorer. The system isn't going to change. Banks aren't going to suddenly start paying you what you deserve. The government isn't going to fix this. Nobody is coming to save you. You have to save yourself. And here's the beautiful part. Once you start, it gets easier. The first transfer is terrifying. The first market dip makes your stomach drop. But after a few months, it becomes normal. You stop checking every day. You stop panicking over volatility. You start seeing the bigger picture, the long-term trend, the inevitable growth. And then, 10 years later, you check your account. You see that number, 6 figures, 7 figures, real wealth, and you realize something profound. The scariest financial decision you ever made was also the smartest. That's the truth they don't want you to know. That investing isn't gambling. That compound growth is real. That you can build generational wealth starting with 100 per month. The information is out there. The tools are available. The math is undeniable. The only question left is this. Are you going to keep letting your money die in a savings account? Or are you finally going to let it live? Your bank is betting you'll choose death. They've built an empire on that bet. Billions in profit. Decades of dominance. All because people were too scared to choose differently. But you're not everyone. You did the math, you saw the numbers. You know the truth now. So stop putting money in savings accounts. Stop accepting pennies while banks make fortunes. Stop sacrificing your future for false security. Start investing. Start building. Start winning. The game was rigged against you. But now you know the rules. And knowing the rules is the first step to changing the game. Your move.